This is question number 5 of homework 4 for chapter 8, problem 8-5. Down under Boomerang Incorporation is considering a new 3-year expansion project that requires an initial fixed asset investment of $3 million. The fixed asset falls into the 3-year MACRS class. So this is short for Modified Accelerated Cost Recovery System. This is specified by the IRS for different asset class. They have different depreciation schedule for each year. So you can find this schedule from the book and also by clicking this table 8.3. This is actually a copy from the book. The project is estimated to generate $2,180,000 in annual sales, with cost of $855,000. The project requires an initial investment in net working capital of $400,000, and the fixed asset will have a market value of $260,000 at the end of the project. If the tax rate is 30%, what is the project's year 1 net cash flow, year 2, year 3? So we should be very careful about the rounding requirement. Enter your answers in dollars, not millions of dollars. So even though some of the numbers we read so far are in millions of dollars, for example, the fixed asset investment is $3 million, but here we need to put that number into dollars. A negative answer should be indicated by a minus sign. So the cash flow for a certain year may be negative, so we need to add a minus sign there. Do not round the intermediate calculations and round your answers to 2 decimal places. So I find using Excel is very convenient to meet this rounding requirement, especially not rounding the intermediate calculations and round your answers to a certain decimal place. It's very convenient to change the number of decimal places in Excel. And using Excel automatically meets this not rounding intermediate calculations requirement. So that's why I choose to use Excel to solve this problem. We can produce, this is, I guess this is a 3 years, 3-year max class. So we have year 1, year 2, year 3, and we can also have year 0, which is current year. Because some of the cash flows, for example, the fixed asset investment is incurred at current year, year 0. So this is 3 million. As we said, we need to put this into million dollars rather than we need to put this into dollars rather than million dollars. So I choose to get this in terms of as a positive number, even though this is a negative cash flow, because later on I want to use this number to calculate the annual depreciation. So in order to do that, I also want to give a name, give a verbal name rather than the sale number. So I can, for example, I just use invest to denote this sale value. So later on, I can just type invest, and then that will go to Excel will recognize it's this number here. So we start from sales in order to generate the cash flow. So sales for every year, it's gonna be $2,180,000. $2,180,000, and it's the same for every year. So I just pull all the way to the right, and so that's the sales and costs. So this includes all sorts of costs, expenses. So $855,000. Again, we can pull this all the way to the right because every year is the same. And then we need to pay attention to the depreciation, right? Depreciation, because that will give us the earnings before interest and the taxes, EBIT. Depreciation is determined by the initial investment, but every year depreciation is determined by the MACRS schedule. You can check based on this table, the 3-year MACRS schedule. The first year, it's 0.3333. So we can use this initial investment. You can see this, as I said, since I give a name for this cell, so when I click on it, Excel will put the variable name rather than the cell number. So times 0.3333. So that's the first year's depreciation. And second year's depreciation is similarly calculated, equals the investment times, go back to the MACRS table. Second year is 0.4445, 0.4445. Now the third year, again, that's based on the initial investment times the third year's MACRS schedule. Percentage, it's 0.1481. 0.1481. So you can see that the 3-year MACRS schedule actually will be fully depreciated over not 3 years, but in 4 years. So that means after 3 years, the equipment or the initial investment still has some book value left. Why this matters? Because sometimes you can see that the last sentence of the first paragraph says that the fixed asset will have a market value of $260,000 at the end of the project. So that means we expect the asset can be sold at this price. But then when the firm sells this asset, it may need to pay taxes. So the terminal, this is called the terminal salvage value. The salvage value, the taxes for the salvage value will be based on the difference between this selling price and the book value of the asset after the 3 years depreciation. And that's why this number here matters, this final percentage at the 4th year, because that stands for the remaining book value of the asset after 3 years depreciation. So we can get that number. We can just this is the why don't I do this EBIT calculation first? So EBIT now could be calculated by sales minus cost minus depreciation. So minus cost minus depreciation. And that's another advantage of using Excel. After 1 year's calculation, you can just pull your mouse all the way to the right, and then the other years will be automatically calculated. So now based on EBIT, we can get the operating cash flow because we said to value our project, we generally assume there's no debt, and then we incorporate the effect of debt for the firm's cash flow into the discount rate rather than the cash flow. So that also means after we get EBIT, we can directly calculate the taxes because there's no interest. So EBIT will be EBT, earnings before taxes. Hence, the taxes will be the tax rate, just 30%. 30% times EBIT or EBT. And you can just pull this all the way. See, the second year is 30% times this D6, which is second year's EBIT, and third year is, yeah, similarly calculated. So that's taxes. And net income, or maybe I don't have to calculate net income. Now I can calculate OCF, operating cash flow. Operating cash flow, as we learned in session 4, I guess, we start from EBIT and then we add back depreciation, right? Because depreciation is not a true cash outflow, even though we have deducted this as if it were a true cash outflow. But since it's not, so we need to add it back. And then we need to deduct taxes, because taxes are real cash the firm has to pay. So it's this, and then pull all the way to the right to get every year's taxes. And you can see that second year taxes here turns out to be negative. The problem here doesn't mention anything about whether the taxes could be negative or not. So negative here doesn't mean the firm, the government is refunding the firm for tax payment. Here it means the firm may have other projects which are profitable for that specific year. So even though here EBIT turns out to be negative, which means that for this project at this year 2, the second year, the project turns out to be a loss rather than earning a profit for the firm. But the loss could still help the firm to shield the positive profits from other projects. So that's why this could be negative, because this negative stands for the because of this loss and because of the profits other projects are earning. So it could help the other projects to reduce the tax payment. And this negative here means the reduced tax payment. So that's why this negative here is still possible. So that's OCF. And we know that in order to calculate the complete cash flow for each year, starting from the current year, year 0, and ending at year 3, we still need to adjust for first the change in net working capital, right? Change in net working capital. And then we need to also consider the terminal salvage value, as we said. So we first consider the net working capital. So NWC, the question mentioned that the project requires an initial investment in net working capital of $400,000. So it's 400,000, and it doesn't say anything after that. But we know that we also mentioned this in our lecture slides. I think in most cases, by the end of the project, all the accounts payable will be paid, all the accounts receivable will be connected, all the inventories will be depleted. So that means all the net working capital, because net working capital is current assets minus current liabilities. So all the net working capital will be returned by the end of the project life. So here is $400,000, and so when it's returned, so that means the project will have a 0. The net working capital for the final year will be 0. And if it doesn't mention, so that means the initial investment in net working capital will be the same. So it doesn't change for intermediate years. Because we care about the change in net working capital rather than the level, right, in terms of the cash flows. So now we can calculate the change. So in order to do that, let me move this cells one one column right. Oh, why don't I do this? Just insert one more column. Why do I do that? Because I want to do the change in net working capital. So I want to leave one empty space because for year 0, if I don't do that, it's going to be year 0 minus this NWC. So that's not what I want. That's why I have to add an empty column here. So now I can do the change. The change for the first year, for the year 0s, net working capital is year 0s minus this empty cell here. So it's going to be the same as year 0s. And then I can pull all the way to the right. And you can see why I add this column. Because for year 1's change in net working capital is going to be this 400,000 minus year 0s. So that's going to be 0. And for year 2, also 0. And for year 3, since the net working capital will be fully returned, go back to 0. So the change will be a negative amount. And the absolute value of this will be the same as year 0s. So that's the change in net working capital. And now the terminal value. Terminal value calculation. So in order to do that, first I get the book value of asset, of the remaining asset. To be more precise, this should be the remaining book value of asset. So as we said, this will be determined by the initial investment times the year 4's depreciation percentage, 0.0741. 0.0741. So that's the remaining book value of asset and terminal market value. And that's given by the setup. The fixed asset will have a market value of $260,000. So just this is 260,000. So now the taxes. This is taxes on salvage value or terminal value. Salvage value will be based on the difference between the market value of the asset and the book value of the asset. And then that's the basis to determine the tax. And then we need to multiply by the tax rate, 30%. Yeah, the tax rate is 30%. So that's the tax. And then final after tax salvage value is simply the selling price, right? That's how much the firm gets. And after the firm pays the taxes, and that's the after-tax salvage value. So it's this number. So now I can do the final free cash flow calculation, starting from the current year, year 0. So it's gonna be the OCF, operating cash flow minus the investment. So now I don't want to click on this cell. Why? Because when I click on this cell, you see it becomes invest. So later on, when I pull the mouse all the way to the right, this invest won't change. But that's not what I want now. What I want now is this investment for subsequent years will be zero. So I want this to change. So in order to do that, I want to change this back to the cell value, which is C2. Yeah, C2. Yeah. And minus the change in net working capital and plus the after-tax salvage value. And for all the other years except for the final year, year 3, the number will be 0, but I want to do that because when I get to the year 3, this number will be, the final free cash flow will be automatically calculated. So that's the first years, I'm sorry, the current years, and then pull the mouse all the way to the right. And this will be automatically calculated. So let's enter your answers in dollars, not millions of dollars. And I think I have done this first part of this question. What is the project's year 1 net cash flow? So just copy number back to the cell in Connect and for each year. And that's another advantage of using Excel. You can directly copy and paste. But sometimes you may need to get rid of the dollar sign because sometimes the Excel will automatically give you a dollar sign. And now go to the second part and the final part of this question. If the required return is 9%, what is the project's NPV? Enter your answers in dollars, not millions of dollars. Do not round intermediate calculations and round your answer to 2 decimal places. So far, actually, the decimal place doesn't matter because all the numbers are integer numbers, right? But when we get to the NPV, since we're discount the cash flow, so the final NPV most likely won't be an integer number. So this part of the round your answer to 2 decimal places will matter. So in order to get NPV, we can just use the NPV function. NPV function. What's special about this NPV function is that you can see the first argument here is rate. So that stands for the discount rate. The discount rate here is 9%. So we just put 0.09. And then starting from the second argument, all these values here stand for the cash flows. But what's special about this NPV function is that you need to start the cash flow not from the year 0, which is the immediate current year, but the first future year, which is the year 1, and then pull all the way to the right, to the last year. So that's how you can use this NPV function in Excel and close this parenthesis. Of course, since we left out the year 0's cash flow, so we still need to add it back. Why do we add rather than subtract? Because we already took care of the sign. Yeah, this is negative because we did the investment, we did the investment in fixed assets, we did the investment in the net working capital. So this turns out to be negative. So that's why we need to add rather than subtract. Yeah, that's sometimes it's easy to forget. So now you see why I said earlier, sometimes once you get this NPV, if you copy it, the dollar sign will also be copied. But that's not what you want because Connect already has a dollar sign. So you want to get rid of that dollar sign there. You can keep the comma. I think the Connect recognizes the comma, but not the dollar sign. So be super careful. Okay, so now let me check my work. Okay, so seems that we have done this question correctly.